All M&A activities are either originated by a prospective buyer or willing seller, while all sensitive activities are usually done by an intermediary, meaning an investment banker or advisor. So if you would like to be proactive, meaning to find an attractive target and originate talks about potential deal, you will need a proper database and screening process in order to identify the right one that fits all your requirements the best, and hire an intermediary to massage the seller or to do it by yourself. On the other hand, you can be less aggressive and wait for the right opportunities to show up. In this case, you should have a proper sort of a procurement system in order to make the projects coming your way, including the detail. You would like to be among the first to receive such information. That is why you should consider hiring an intermediary or advisor, and have a proper database and trustworthy analyst to check if the opportunity is good enough for you or you should skip it. Either way, you will get a teaser from a seller, giving you some basic information about his company, so you will be able to decide either to pursue further investigation or not. If you would like to get some more detailed information, you are going to sign an NDA, meaning non-closure agreement or confidentiality agreement. NDA is a type of a document that should secure confidentiality for all the parties. Just like you wouldn't like to hear around that you are bidding for some company, especially if you are publicly traded and must be cautious about managing your own investor relations, they wouldn't like someone to share their own confidential data around, including information they are on sale. Confidentiality agreement is usually prepared by a sell-side advisor and should cover formal aspects like involved companies, their addresses, legal representatives and similar, type and nature of confidential information, meaning what should be covered as confidential, legal requirements regarding representatives' behavior, meaning who will have the access, what are consequences and penalties of breaking the agreement, in which cases confidential information might be shared with authorities and how, period on how long it will be effective, explaining what to do with the information after that specified period and similar. Should be signed by both parties, meaning seller and potential buyer, before data exchange. As you can notice, this type of a document is prepared by lawyers. In some cases, a seller can accept an NDA coming from a potential buyer if he would like to speed up the process. Sometimes potential buyer might have a really slow and demanding procedure for external documents approval. If seller accepts their document with his minor changes, it might be just much faster, but it's up to him. After exchanging signed NDA, a seller's advisor will send you a process letter and an Info-Memo. The main purpose of a process letter is to explain your rules of the game, meaning the next steps and desired project dynamics. For example, how the bidding process is organized, as a competitive, meaning with a lot of players bidding for the target, or rather in a more private mode, meaning there might be few interested parties at max. When you can visit the company and ask relevant questions, when is the deadline for potential buyer to submit his MBO, what should be the selection criteria for due diligence. For example, only top 3 bidders ranked by price offer will be invited for next steps, when virtual data room will be open and for how long, what is the planned deadline for binding offers, what is the planned deadline for deal closing, and similar. As you can see, this is a sort of a roadmap for all the players. It will clarify for you the entire process and help you plan your own dynamics and resources. For example, to hire your own advisors, lawyers, auditors, and talk with bankers about financial sources if needed. In addition, it will give you a sense of professionalism, transparency, and fairness as well. Next, Info-Memo or Information Memoranda. This is a core explanatory document, usually 30 to 60 pages, written in a Word document, sometimes even more, created by seller's advisor based on his inputs. Here, you as a potential buyer will be able to ideally find detailed information about company profile and its history, processes, products or services details, including route to the market description, key resources and capacity utilization, financial information details and explanations, organizational structure and management team, market overview and positioning, other business aspects like ecology, taxation, litigations, etc. Basically, these items should be covered, putting more or less attention to specific details depending on industry and business type. As you can see, the main purpose of this document is not to be salesy, but to give you informational foundations so you can understand sellers' operations, resources, potential risks, and assess the business value. As you can assume, users of this document will be analysts and other experts from buy side, or your side, while top executives will most likely pay attention to Info-Memo's executive summary and materials prepared from your own team, from the extracts of the document. In some specific cases, for example, if you know potential seller very well, he may decide not to prepare an Info-Memo, but to send you directly a set of raw information in Excel and Word documents as per your request. However, this is rather an exception than the usual M&A practice. Creating an Info-Memo will not take him much more time, but it will give a seller more professional credibility. Please have in mind that some elements of seller's business plan, meaning forecast for next few years, might be included at Info-Memo, especially if he has a fast-growing business, has prepared changes that will be visible in the coming period, or he is struggling, so he would like to highlight potentials. As mentioned, you are going to use the data coming from Info-Memo and combine them with your own intelligence in order to prepare a business plan and valuation. Usually, a buyer will prepare a financial model, it will be explained in the next section in detail, and collect relevant comparable transactions. And most likely, he will go step by step, first preparing just a rough estimates and pair them with valuation multiples in order to assess fair market value, and next, how much the business is worth to him specifically, meaning after applying the potential synergy effects or some other specific plans how he is going to run the business. For example, he might use his planned margins versus the margins achieved by the company, apply its own logistic costs instead of sellers based on his own logistic infrastructure, assume selling some non-core assets and similar. Simply said, it is crucial to test or simulate how the company will perform after the acquisition. It might be worse or better compared to the current level of operations, depending on assumptions he is going to apply, meaning depending on the way the company is going to be run after the deal. That way, he will be able to understand how much to offer and how to structure the deal. He will use the conclusions to submit a non-binding offer, and if the seller accepts it in general, he will be qualified for the next stage, due diligence, where he will be able to check all information and fine-tune the model and his valuation before submitting the binding offer. So, your next task is to qualify for due diligence, meaning you have to submit a winning offer, or an NBO, meaning non-binding offer. Align a term sheet, memorandum of information, or letter of intent. Let's explain. Term sheet outlines the primary terms with the seller and is often used as the basis for a more detailed letter of intent. Usually, it is a Word document written on few pages, stipulating purchase price, more likely as a range, not a fixed number, what is going to be acquired, assets or stocks, limitations of the use of proprietary data, no shop agreement, meaning preventing seller to share the terms of the buyer's proposal with other potential participants, and termination date. Many transactions skip the term sheet and go directly to a negotiating letter of intent, especially if there is a competitive bidding process. LOI, or letter of intent, is basically a sort of a further development of a term sheet document and is used to clarify early in the process areas of agreement and disagreement. Most likely, it will take 3 to 15 pages in length. Although that is not a type of a document where you have topics that you must all to cover, it usually covers most of the following. Formal aspects, explain who is sending what to whom and why, identification of the buyer, a short description of potential buyer, what is he doing, how successful he is, and why he would be a great choice. Indicative offer, this is the most important segment of the document. Here potential buyer is giving his offer in terms of price and structure, meaning how much is he willing to pay for a defined stake, usually given as a range or multiple to EBITDA or free cash flow to firm or some other indicator. What is the targeted stake or set of assets depending on deal type, type of payments, cash or stocks, and treatment of target company's liabilities, structuring upfront payments and earn-out elements if there are any, defining triggers or on what it depends, meaning targeted achievements, and when it should be paid or payment dynamics. Who will be the buyer, for example, an existing entity or newcom, other relevant offer elements. Next, key indicative assumptions and principles. Basically, this is a sort of a disclaimer and an instrument where potential buyer explains his core assumptions and secure the space to adjust his offer up or down later on. This is an indicative offer, meaning non-binding, and highlighting that offer is the subject of due diligence, regulatory and internal approvals. What are the core assumptions used, like provided free cash flow, EBITDA, estimated capex needed in the coming years, what might happen with some licenses, expected new contracts that seller promised to sign before the deal closing, etc. Expectations that additional new debt will not be drawn, or some large long-term investments will not be undertaken by seller, or some other major events will not happen before deal closing. It will indicate the responsibilities of both parties while the agreement is in force, a reasonable expiration date, and how all fees associated with transaction will be paid. Most likely within this point, potential buyer will ask for exclusivity, meaning to be the only one that will be taken into consideration as a potential buyer, excluding all others. Next, envisioning timing of the process and corporate approvals. Here, potential buyer will present his expectations about required time needed to perform due diligence and submit a binding offer. This is a great place to highlight the importance of exclusivity period, especially if it is not mentioned before. Expected timeline should more or less correlate with the dynamics presented within process letter. If the potential buyer might face a longer period for internal or regulatory approvals and securing financing, this is the place used to explain that. Next, source of financing. This might be a very important point for seller to get some understanding how the deal will be financed. Usually, potential buyers highlight their sound financial position, meaning they either already have sufficient sources or have credibility to secure it through cooperation with banks or at a financial market. Hint, some potential buyers might intend to use a targeted company to be collateral for their planned acquisition capex, and later on that debt to be transferred to this targeted or acquired company. It does not have to be an issue per se for a seller since he is exiting, but it might affect life of his team members who have to create that cash to pay out that debts. And think how desired this type of potential buyer is, since it might affect M&A project dynamics as well, meaning It takes time to secure financing and might put a seller at risk if the financing is not approved. Next, cooperation with current management. This section is important to explain specific expectations regarding entrepreneurs' role in post-transition period, importance of current team and buyers' plans to bring new people. Deal rationale. This is used to highlight some specific moments regarding potential transaction motivation, for example, ongoing market consolidation, sellers' restructuring process, etc. Next, non-binding nature of the offer. This is used as a reminder and a disclaimer to highlight non-binding aspects of the offer. And finally, contact details. This is used to give an opportunity to speak about offer if needed, to adjust it, formally to clarify it, and to express target's importance and respect by incorporating top-ranked executives or partners from the buyer side. To conclude, this is an offer that will help a seller to decide either he is going to continue with the M&A process and select or shortlist potential buyers. Since it is non-binding in nature, meaning the only binding items are confidentiality, and if the seller accepted exclusivity, it will not give him any guarantee that you as a potential buyer will stick to it. If you find something that you don't like during the due diligence, you can always walk away. However, it is a great step in clarifying positions, mutual expectations, and potential red lines, and based on that, to enter among shortlisted potential candidates.